welcome to the HX webinar series, Once You Go Direct, You Never Go Back. My name is Scott Jordan. I'm the founder of HealthiosXchange, and I'm pleased to introduce David Drake, the founder and chairman of LDJ Capital, a private equity firm in New York City, and the Soho Loft, a global financial media company. I'll introduce David here in a few minutes, but I just want to say a few things here. HealthiosXchange is the premier investment marketplace dedicated exclusively to the global healthcare industry, employing crowdfunding as the cornerstone of a new funding paradigm. HealthiosXchange offers direct access to the broadest opportunities on a fee-free, carry-free basis in the most trusted online environment. You'll be placed in listening mode only. If you have questions, please submit them by entering them into the chat box. We will both be answering questions throughout the presentation, including a brief Q&A session at the end of the webinar. We are recording the presentation, and it will be we'll provide that, send that to you following the webinar. Okay? So thanks for joining us. This will be about 20 to 30 minutes. Just to let you know, the agenda for there's eight areas here. So first of all, I'm going to introduce David Drake here in a few minutes. We're going to talk about what direct investing is. We're going to talk about what is enabling direct investing, what is the innovation gap, can direct investing fill the gap, HealthiosXchange enabling direct investing, and then we will, David Drake will take over and talk about crowdfunding, the Jobs Act, and he crisscrosses the planet talking about crowdfunding, etc. So it's very exciting to have him on the call. And then lastly, we'll provide contact information from our side, and then also David, in case you would like to follow up. Okay, having said that, let's introduce David Drake. David, take a few minutes, talk about yourself and what you're doing.
Well, thank you, Scott. I appreciate that. You are actually catching me in London today. I just left Italy a couple of days ago, and I'm going to be at Parliament tomorrow, as well as Cambridge University to speak. So I'm, as you said before, I've been traveling every week to different countries all over the world for just about the whole year. And, LDJ Capital, which is our private equity advisory firm, we were historically in as general partners in a couple of funds. And we made an investment about 3 years into the Soho Loft, which is a media company today. We did that investment 3 years ago for our family office network and institutional investors. Lo and behold, it ended up being 2011 election year. And all our speakers, and we have 3-4 events a month, ended up going down to D.C. as sub-congressional witnesses. And before I know it, I'm in the middle of all the 6 underlying laws in the Jobs Act and, how they've been evolving over the last few years, and deconstructing our funds, private equity, business angel networks, venture capital, debt, corporate finance, and other solutions are being handled in different countries all over the world. So, today we'll talk about a bit of crowdfunding and how that affects direct investment, and I'm looking forward to sharing that with everybody else. Thank you, Scott.
Thanks, David. Appreciate that introduction. So let's dive in here. What is direct investing? So direct investing is essentially investment in emerging growth healthcare companies without paying the 2% management fee and the 20% carry that you typically see with venture actually investing through funds. So why is 2 and 20 important? These are 4 reasons. It all has to do with it negatively impacts returns. So the Kauffman Foundation came out with a study here recently, and they were talking about, they actually had a bunch of investments in VCs and were trying to gauge how well their funds were doing, and come to find out it wasn't working very well. So first of all, average VC fund barely manages to return the investor capital after all fees are paid. From 1997 to 2009, only 5 vintage years in which median VC funds generated IRRs that returned investor capital. In their portfolio, 20 of 100 venture funds generate returns that beat public market equivalent by more than 3% annually. And VCs incentivized to raise large funds, which is the 2% management fee. So the bigger the fund, the bigger the fees, and that comes out of the investor's pocket. Big funds are reluctant to invest in early-stage companies, can't put enough money to work, thus that created some of the innovation gap. And large funds underperform on a consistent basis. Okay? So let's go to the next slide. So what is enabling direct investing? And by the way, this ties into what David Drake's going to talk about with crowdfunding towards the end of the presentation. Since crowdfunding is one of the primary vehicles for enabling the direct investment revolution that we're seeing. So what is enabling direct investing? There's four primary forces that start up in the northeast corner, upper right-hand corner. First of all, the Jobs Act, which David is an expert in, and he's going to tell you a little bit about the Jobs Act. But two of the titles in the Jobs Act, which was signed by President Obama in 2012, and recently general solicitation was passed. I think it was the 23rd, I think, of September. That was Title II. And then you have the shareholder cap. Actually, shareholder cap is Title V. So between Title II and Title V of the Jobs Act, essentially what it meant was you didn't have to have a pre-existing relationship to solicit somebody. And the other thing was if you're gonna raise a small amount of money from a large group of people, which is the definition of crowdfunding, then the shareholder cap is a big deal. So it used to be 500, and then you had to file SEC documentation. Now it's 2,000. So that really helps. Down in the lower right-hand corner, marketing reach. So social media, so the revolution in social media. So the ability to leverage this general solicitation or to get out your offering to a large group of people, and there's been a real revolution there. To the left, tagging data, Match.com. It's kind of funny when you talk about it, but it's called metadata. And basically what we're doing is we're tagging investor preferences that they have in their profiles with the actual investment itself. So if I put oncology in my profile and there's a new oncology opportunity, then essentially you can match those two investors. So it's efficiency of data. And then up in the upper left corner here, raising a small amount of money from a large group of people, that's essentially the essence of crowdfunding. So you're lowering the investment threshold. And in an industry that's very, very risky, you're giving investors the opportunity to diversify their portfolios, which they didn't really have that opportunity in the past, at least with angel groups, and with putting a bunch of money into VC funds that have massive minimums for accredited investors. What is enabling direct investing? Again, a summary here. Crowdfunding, so we defined it there. Social media, which we talked about. Advancements in technology, which we talked about. The success of donation rewards-based platforms such as Kickstarter and Indiegogo. So you'll see that those have been very, very popular and very successful firms. The peer-to-peer revolution here, as far as I lend you money without a bank, that's Prosper Lending Club, and you'll see that they're going to originate $2 billion in 2013. So from a peer-to-peer perspective, it's definitely on fire. And then lastly, but not least, equity crowdfunding. I just named three platforms here. First of all, technology with Funders Club out of San Francisco. In the consumer goods area, Circle Up. And then on the healthcare side, HealthiosXchange is one of the firms that's actually in the healthcare area. We take a look at the Jobs Act, and of course, David's going to speak in more depth from a global perspective. But you'll see some of the highlights which we touched on. The one below, the second one down, listed general solicitation ban, is a major area. It raises the shareholder cap, which we talked about. One of the things, a few that we didn't mention, was increases the limits on Reg A from 5 to 50 million, and it legalizes crowdfunding. Actually, that's there's some guidelines that just came out, and where we'll be waiting, I don't know, 90 to 120 days to see. That's actually Title III, which is non-accredited investors. And keep in mind that the HealthiosXchange portal is just for accredited investors. Some people call it rich man's crowdfunding. So those are some of the, and by the way, you'll be able to peruse this deck at your leisure following. We'll send it to you. Crowdfunding targets, direct investing, lower. What's disruptive about it? Lower than cost structure for investors. So let's take a look at three markets here. Reg Ds on your left. These are largely dominated by public non-traded REITs and oil and gas investments. However, and they do include private placements as well. You're talking about $1 trillion industry. Unfortunately, the way that people invest in private placements is through broker-dealers typically, and those broker-dealers are taking anywhere between 8 to 15% fee, whereas a lot of the crowdfunding portals are at 5% or less of the success fee. On the angel investing side, $22.5 billion invested in 2012. The problem with angel groups are what? Annual dues, that bothers some people. Participation, maybe you don't want to go to group meetings and participate. Geographical boundaries, which I didn't put in there, but I don't live in San Francisco or Boston and I want access to the next Google or Onyx or Regeneron Pharmacyclics. It's tough. And then on the venture capital side, you have basically $30 billion, and that's the 2 and 20, which we were talking about. And obviously, we're talking about trying to, provide an avenue for angel investors and accredited investors so that they don't have to pay that 2 and 20 to have access to premium deal flow. So what is the innovation gap? So here's a definition of it. You see here it's a series of irrational systemic dysfunctions or gaps in the global healthcare capital flows, and they can be somewhat irrational, for example. And you'll see on this, this would be more for pharmaceuticals and less so for medical device, but we have some gaps here with the stars. So you're typically seeing a gap at, a lot of times at a series like before a Series A, even though things are changing, by the way. But there are these gaps in the life cycle of capital, and unfortunately, the number of VC firms has plummeted, and they're all doing large syndications. So it's really difficult for companies, especially between San Francisco and Boston, to get the attention of venture capital money. Thus, crowdfunding fills the innovation gap, or has the potential to fill the innovation gap. So let's take a look at the innovation gap. What's one of the reasons why there is one? Well, we just talked about it, venture capital investing. So the number of VC firms declined by 62% over the past decade. The aggregate annual investment is down. Since 2010, 77% of the capital commitments to VC funds has been raised by 30% of the VCs. So there's a real concentration there. Between 2006 and 2011, 52.7% of financing events were supported by investor syndicates with 0 new investors. So it goes to show you that you either get in this small group of VCs or you're out of luck. In 2012, 300% more capital was invested than was raised, and that has changed somewhat this year as well, since Versant, Sofinova, Third Rock, and Atlas and Fraser have all raised funds. However, it's not going to be enough to fill all the capital needs that are out there. So HealthiosXchange, which I'll show you in a few slides here coming up, it's a healthcare crowdfunding portal, and essentially what it's meant to do is go from seed to exit, which you'll see on the left-hand side, which is the crowd finance portal, and it goes through Foundation, Place, Express, and Market, and then secondary trading in the future will be called LiquidNet. So we'll talk a little bit more about that in the future, but it's important to have a seed to exit approach due to the capital intensity of the industry itself. This is not one of those industries where you can, raise $200,000 and create a Facebook. The average company raises, I think, about $49 million in the pharma space over a 5.7-year period, and crowdfunding will not get it done alone. Can direct investing fill the gap, this innovation gap? So one of the things that is really, really interesting is that there's 8 million accredited investors in this country, 41% who have invested in VC funds, yet only 5% have invested directly in a Reg D offering. And there are big reasons for that, which we've already mentioned, which I'll state again, which is even though healthcare ranks as a top priority for these investors, you'll see biotech, healthcare services, and medical device and equipment always, there's a ranking of it from angel investors. They all rank very high. The reason why they don't invest directly is essentially a lot of times they don't even have access directly. And then the way they get direct participation is to join an angel group, which we've talked about some of the limitations of angel groups already. So why such low participation? Again, right? And this is one that I didn't talk too much about, but the investment thresholds are too high for the level of risk. So if the odds of a biotechnology approval approaches 30 to 1, and angel groups are typically requiring a minimum investment of $25K, most wealthy people are not willing to put a ton of money, like $25K, into one company when the odds are 30 to 1. The other thing is that other investors, you actually penalize yourself sometimes by taking investments under 25K outside of a crowdfunding construct, which I'll explain in more detail, and that is because of a fractured cap structure. So what does crowdfunding and direct investment do? Well, how does it enable this? Well, first of all, the participation rates of accredited investors should go up because there are low investment thresholds. So the aggregate investors, we aggregate investors into what they call special purpose vehicles, which are LLCs that act as a single shareholder. So the way the laws are written today, you can put 95 investors into an SPV, and that counts as one shareholder. So it consolidates the capital, even though the investment thresholds can go as low as $1,500 per investor. The second thing is what they call investor syndicates. You've probably seen this with AngelList. The situation with AngelList, they're doing a great job, is that you basically can get a lead syndicate member investor who gets syndicate investors to fund his, well, I'm getting redundant, but you have a lead investor and you have syndicate investors, and the syndicate investors invest in the lead's deal. And that lead is one shareholder. So you can see that you can start to scale and still maintain that under 100 investor SPV type model. The other thing is crowdfunding. We don't require you to pay annual dues or participate in groups. HealthiosXchange is a free site. So you can come into the portal, you can list your company, you can interact with investors, you can leverage research and join conferences and like this webinar free of charge. It eliminates geographical barriers. You're rich but don't live in San Francisco or Boston. So, you know, a lot of these people that don't live in those two cities don't get access to the angel groups and thus don't get access to the next Googles. And the easy-to-use e-platforms. We have e-legal, e-compliance, like escrow. Everything is electronic. Viewing the documents, putting your money in escrow, the money being released, e-signature. You have to make it really, really straightforward for investors. So that's why we feel that crowdfunding can help fill this innovation gap. So HealthiosXchange, I just got a few slides here I wanted to go through. This platform we launched in August of this year. We have over, we're coming up on 1,200 members. Those members are accredited investor professionals, emerging growth companies, and strategic buyers. And you'll see that we have, our goals are 100,000 accredited investors, institutions, non-for-profits, but we have a very robust ecosystem. It does service the needs of all capital sources and has a lot of LinkedIn functionality, a lot of Match.com functionality. So there's no adverse selection. It's open access, perfect information, right? Is perfect markets. So the crowd anchors the continuum. There's transparency. There's no orphans, no adverse selection, meaning that we don't curate the deals per se. We do have a scoring system there. Number two, the bottom line is that we don't want selection bias, meaning we put up 5 deals and then you ask, well, what about the other 100? I mean, you might want to invest in some of the other ones. Fee-free, carry-free, that's essentially we don't charge a retainer and we don't take carry on the money, thus the alternative to the 2 and 20. No adverse selection. So this means, once again, everyone's welcome. So right now we have 5,000, probably have more than that, but these were venture-backed companies we loaded, and then because Healthios, the parent company, has an expertise there, and we have been adding non-venture-backed companies for the last 2 months. Each company gets their own page. It's actually 46 market sectors, not 41 now, organized by ecosystem, and you can create watch list and catalyst updates. So there's a lot of great functionality there. Our goal is 100,000 investors. We're not there yet, but we're climbing very quickly. You'll see those investors will come from a myriad of different sources, and we have a lot of technology to match, investors with companies like HubSpot, John Ray, etc. And it has a very robust custodial portfolio management processing platform. One company, one page. This is what your page will look like when you list on HealthiosXchange. This is where investors will come, and strategics and venture capitalists. And you'll see any things such as fundraising targets on the right, deal points, followers of the company. You have tabs like highlights, Q&A, and it's think of LinkedIn company pages. So we monitor who comes to your site, and etc. And there's a scoring system as well. So having said that, David, I've taken up enough time here. So maybe you can talk a little bit about this revolution that we're seeing in crowdfunding and how you're involved with that and the implications for companies that are seeking capital.
Well, thank you for that thorough work, Scott, and thanks for having me. I've been deconstructing crowdfunding and all its means, from private equity to hedge funds to business angels, and also reward donation, equity, and debt, which are the four major areas for it. What I'm seeing all over the world this year, and what's going to happen in 2014, besides, now we have a proposal from the SEC, which means the clock starts ticking, but that proposal was 585 pages with 295 questions. Interestingly enough, there's been fallacies running around that you cannot charge commission as a platform, but you can, and that is the intention of SEC. Now, what FINRA will do, it's going to have to be compliant with what SEC says, but the equity portion of it will hopefully be legal by end of summer 2014, unless the staff needs to do a second public commenting, because from 295 questions that needs to be answered, but multiple answer, it's going to be a lot of work for the SEC to put together, and it's not unheard of them extending that. Right now, crowdfunding for equity is, well, the UK is the lead in that space. They've had operations for the last 3 years. Some of them with FSA approval, which is the equivalent of SEC. Today it's called FCA, and some of them not. So today there's 3 organizations in the UK that have approval for FCA to operate and do crowdfunding for equity. And, while you have AngelList being very active on the other side with, syndicated deals with angels and doing, $12 to $13 million in deals per month, there are many interesting developments occurring on a global basis. I mean, even though, we broke the news that Italy was just passed a crowdfunding law, Italy hasn't had anybody actually conduct a crowdfunding transaction on the new law for the last 2 months. Maybe it's in 3 months. So it's not always black and white, and, we need to answer these questions for the equity to become legalized in the U.S., which is Title III, which you mentioned before. And the challenge is, how are you going to deal with, 2 simultaneous offerings? Title II allows you to advertise for accredited investors in the U.S., and as you said, there's over 8 million of them, while Title III is crowdfunding, where you can have an unlimited amount of non-accredited investors putting money in. Well, that, like you said before, it's going to make an issue. It's going to create an issue with the 2,000-person rule. That's the maximum private company can have. So granted, you could put them into SPVs, but crowdfunding rules indicate that you're not allowed to do any SPVs or commingling of the investors into one entity. That's not allowed according to the Jobs Act specifically. So we'll have to work with SEC to see how to solve that portion, because the institutions and everybody on Healthios is going to say, well, if you get 5,000 investors, that's going to break the rule of the 2,000 investors. How do we integrate that? Some of my suggestions is you have a drag-along clause. If then owner is selling part of the shares, it's a trigger, and maybe some of the crowdfunders get a certain return and be able to exit. But we'll have to see how that's going to be solved by the SEC. Now, crowdfunding is being used now across, all kind of industries. And obviously, Healthios is attracting a technology solution that is badly needed, and I haven't seen anybody else do that. By taking technology and automating that process of allowing individual investors to look at solutions, but also track and have more transparency, because that's really what crowdfunding and other technologies have offered. A transparency into how things function and a better communication tool, better investor relations platform. If you look at some of the countries abroad, Holland and the UK, and they've done some research on, how crowdfunding has been working for them on the equity side the last few years, the engagement of people that can actually get involved in the voting of new executives or board members electronically, it makes them very passionate, and they have a very high retention rate. People who put money into crowdfunding in Holland and the UK, from our research, shows that they roll the money over and they keep the money in there for the longest time because they want to be involved and help, but they just don't have the means or the knowledge to do so on a full-time basis, a part-time basis. So I think we're going to find the same thing here, that people feel that they're engaged, they're part of the creation of these solutions, and they can actually do something and get instant communication back on voting, on shares, on developments, and press releases. I mean, ideally, the stock market should be emulating what Healthios is building and what other technologies like crowdfunding is creating, because there is the transparency. You know, and Scott, on the note, you know, in the early days, like, which was just a year and a half ago, you know, crowdfunding platforms wasn't really aware of communication issues. And, you know, they learned over the last year and a half that there needs to be newsletters. You need to be able to follow up and say thank you. A lot of people in the crowdfunding community that used to give money complained that, well, I just gave you money and I didn't get a thank you, a follow-up note. And that was the issue we had a long time, only a year ago. So we're going to see other challenges that I see Healthios is addressing in solving that communication to IR. In addition, you know, I'm looking at, you know, pre-revenue, early-stage companies. They should be using crowdfunding like Healthios and other platforms, because it forces them to educate themselves and stick within the parameters of the platform. And by not even realizing it, they're learning what is necessary, how to communicate with their investors, how to reach out to them, how to raise money, how to have governance and reporting. So I also look at this as e-learning, or a way for entrepreneurs, instead of saying, no, you cannot come here, saying, hey, you know what? Here's the platform where we're not going to say no. You can come on board. And the structure is such that you'll see how to operate and communicate and work your company with IR, communication, and PR, etc. So yes, you know, I've been very excited about this for a long time. And, you know, it's not always best to raise capital or look at crowdfunding abroad. You know, we just read an article about IBM. They've done their third internal enterprise crowdfunding campaign, where they allocated money to a select group of researchers within a department, and then allowed them to have around $50,000. And then they could actually allocate that money within 30 days to different projects that they could actually get exposed to within IBM. So on the enterprise level, we started seeing some other reactions and communication that started occurring even between countries and across departments, and even between people who have never met each other, but all of them worked at IBM. So I think you're also going to see some developments on the enterprise level the next 2 years. And this is, you know, something I talked about a year and a half ago, saying, you know, the enterprise level, when they start embracing this, and this becomes commonplace across the board, then communication starts on a very different scale. Because, you know, if you look at the research side of things, you know, if you have a chance to engage your investors in the solution or feedback, then you're empowering people to, you know, be more involved. And we've seen some research out of Milan showing that, you know, what we thought engaged people to donate money or give money was not necessarily their rewards per se being a thing, but rather their engagement in the development process itself. So, you know, let's talk about Healthios, for instance. If there's a pilot program, well, maybe not a pilot, but if there's a think tank or a feedback or a processing that could be part of the crowdfunding, the engagement will probably be much higher, because the people giving money feel that they can also be involved and they can actually bring something to the solution. We've seen this in the gaming area, where, you know, people can be part of the development process of a game, and also in the film and art area, where people can be part of the storyline or part of developing it further down the road. So I think those are certain things that are the new trends that we're going to see in 2014, 2015. And as you said before, you know, today, crowdfunding is becoming more and more acceptable in the U.S. and UK. And I keep talking about UK because they get something beautiful. It's called the Seed Enterprise Investment Scheme. And technically, you can actually take 50% of the money put into a startup, up to £100,000, and deduct that against your salary, as long as you hold it for 3 years. So after 1 year and you do your taxes, you send in, let's say, £10,000 that you invested. The government then will give you a check back on £5,000 and the taxes you should have paid on it. And that's why startups in the UK are really getting a lot of momentum, because and I haven't seen anywhere else in the world where you can actually deduct your investment against your personal salary. So that explains, why everybody keeps talking about the UK, and I think it's, interesting to hear about that. It's so different there compared to any other country I've been to. And by the way, Scott, I've been to about 20, 25 countries just the last 8 months, traveling and talking about capital formation, and also deconstructing how they're doing it, both from funds and quasi-government agencies to debt, to fund of funds, even guarantee funds and business angel networks, etc. So it's exciting to see what's happening, and there seems to be a whirlwind of developments globally, and some developments that I thought was exciting 2 years ago didn't go very far. Now when I review them, and some developments are coming up now and it's taking speed much faster. I think you might have mentioned it, but Lending Club is actually going to be doing a $2.1 billion in 2013. I speak to them every week. I've been working and covering them and writing about them for over almost 2 years, and I've been very impressed that they actually finally figured out how to scale. And they're doing at least 60% institutional money. So finally, in crowdfunding, institutional money has entered, and they entered maybe 6 to 9 months ago. It's not it just happened, but for Lending Club being at 2.1 billion, reports you have out there talks about 5.1 billion being the whole industry this year. But when that report was written by Mass Solution, that was questionnaires going out in mid-2012. That information is 1 year old. And at that point, the run rate for Lending Club was around maybe 500-600 million just for 2012. Today, they're tripling to 2.1 billion, so that skews it. One company stands for more than 35% of the whole industry globally. So, so that's just mind-boggling that one company just took off, and still there's not that much talk about it, as I would expect in the news. I'm just excited to see that that's taking form, and I'm excited that now, as an asset class, pension funds are putting money into them. And they put money into the debt from Lending Club. It will stay there for a very long time. And health just has the same promise where you actually be able to put money in from institutional levels for a longer term. And I think this is going to be the next 24 months. It's something that's going to pop up much faster. Funding Circle that does debt in the UK has, now Santander, the Spanish bank, supporting and putting money in towards it, as well as the UK bank. So there is, developments happening, yet the scale is not there with Funding Circle, like Lending Club, of course. So I think I covered some of the trends in the industry and what's happening on a global basis. We talked about some of this when we did the Thomson Reuters conference earlier this year, and a lot of these things are coming to fruition. But yet again, we keep forgetting, everybody who's listening to this says, wow, this crowdfunding is exciting. I still believe that a good 95% or 98% of the population of North America don't know what crowdfunding is. And most of them never heard of it. I still come across people, just as recently, a couple of weeks ago, the marketing director out of Atlanta in the mid-30s, never heard of crowdfunding, had no idea what it was. So, we need to remind ourselves, we might just be scratching the surface, which means we have a huge upside. Just talk about those 8+ million accredited investors we have in North America that are not going to be reached by advertising. And Scott, I wanted to briefly talk about that too, because the Jobs Act had 6 underlying laws in it. And that advertising that's allowed under Regulation D has a challenge today. The challenge is, and that's why you haven't seen much of it, even though it became legalized on September 23rd, the Federal Registry ended after 60 days and it became law. The challenge is that lawyers and accountants have to verify as third-party verification services that somebody has $1 million net worth or has the salary that they claim they have. And a lot of them are resisting doing this because the liability might be too large. And because of this issue, there's a little hiccup, and we're waiting to see what's going to happen. Who's going to make the first move and see how that's going to move forward. Because if the lawyers and accountants say, well, listen, I might see his bank account, but I don't know if he has, $50 million debt in another country or somewhere else, because it really talks about net worth. So we'll have to see how that works out. But I've been very optimistic on that law because, you know, when the SEC talked about that August 29th, 2012, they did release that by 2011, Reg D 506, which is the exemption on the SEC regulations, we're doing $896 billion, just short of $1 trillion in transactions under that exemption. So the idea and the goal is to unleash that as an advertising opportunity to reach more investors that hasn't been reached before because you don't have a pre-existing relationship with them. You know, there's, of course, 4 or 5 other parts of the Jobs Act, but, you know, I just wanted to touch on advertising on 506 and, of course, crowdfunding as we discussed it, but that we're still working through the questions. So, Scott, I hope this answers most of your questions, and do you want me to add something else?
Yeah, we got a couple questions there. Number one, what country is the most progressive right now with crowdfunding on the equity side?
Progressive. Yeah, progressive is UK. It's because, you know, one part is you know, you can deduct your salary against the investment you made. Part 2, if you hold it for 3 years, it's tax deductible, any capital gains. So technically, if you make a home run after 3 years, you don't have to pay any taxes on that income. And, you know, they are moving towards making it easier to raise money on crowdfunding. I'm going to be at Parliament tomorrow and speaking at 2 conferences here in the UK. So those are the things that makes the UK the lead. Furthermore, you know, crowdfunding for equity till in 2012 was only 3-4% of the 2.7 billion that crowdfunding in general has accumulated on debt, reward, equity, and donations. And a lot of that was from the UK. Yeah, I would say Crowdcube today has probably done $30 million in crowdfunding for equity, and they would be the leader globally. However, you know, there's also accredited crowdfunding, you know, the syndication of AngelList and syndication of Funders Club, where, you know, you typically have accredited investors doing crowdfunding. So it gets really gray because everybody's using different definitions and the word is being intermingled. But yeah, to answer it simply, UK.
Okay, second question. I represent a foreign company that seeks to raise crowdfunding capital via a U.S.-based firm. Can I do this? What are my options?
Well, if it's on equity, you have to incorporate in the U.S. So you would just have to incorporate in, either, you know, in Delaware or in Utah, one of the states, and that would be the company that then would be on the crowdfunding platform. You know, for instance, Seed Invest today does, you know, 506 and also the VC structure of SPVs. So they're you know, they have a structure where they're asking everybody, like Healthios will do the same thing. So you're just going to have to be incorporated in the U.S. So there's recourse and also shares in the U.S. Now, if you're doing non-equity, let's say rewards and donations, then, you know, the different platforms have different restrictions. For instance, Kickstarter, you have to be in the UK or the US bank account to be able to do Kickstarter campaigns, while others like Indiegogo will let you do a Kickstarter campaign from anywhere in the world just about. You know, yet again, I know Swedish firms and foreign firms that will actually open up a bank account in a company in the U.S. and do the crowdfunding and successfully raise money for their operations in Sweden. You know, a good thing would be for people who are interested in learning how it can be done and what the options and what the best practices are. You know, shoot me an email at david@ldjcapital.com, and I'll see if I can, you know, micro fit the answers even further, and maybe even send some references that you can talk to. Because if you're dealing with the 506C regulation, there hasn't been one done yet. So all the rules and expectations are not set. And on the crowdfunding side, you know, as we want it to be, well, that's not going to happen for another year and a half on the Jobs Act, but crowdfunding for accredited investors, the Healthios offers, that's a different platform, and that can be done today.
Okay, last question we have, which is the amounts raised thus far have in healthcare or crowdfunding overall have been very modest today. Given healthcare is a capital-intensive industry, what role will crowdfunding have or play in the space? And do you anticipate the amounts of money raised to project to increase? So I'll just take that real quick. So yeah, that's absolutely true. We're in the beginning innings of this crowdfunding. I don't even know if you want to call it revolution, but chapter. And so, Circle Up and Funders Club have had a great deal of success raising, I don't know, David, I mean, they're in like maybe the $13, $15 million range at this point. AngelList, is saying that they have $2 million a month going through their portal and like 7 or 8 outside of it. So we do feel that it will, it will increase over time. I do think that you can't just look at equity crowdfunding. You got to look at debt crowdfunding as well from the venture debt side, and then also royalty-based agreements. And then lastly, it's not just private companies, but you could have crowdfunding for public companies, pipes, ATMs, and direct listings. So anyway, just want to thank everybody for participating. Thank you, David, so much for taking some time out of your schedule. If you'd like to get a hold of me, this is my contact information. Be more than happy to take you through the portal. And thank you so much for participating today. Talk to you soon. Bye.